Hey everybody, I'm Tai DeSa. Welcome to the channel. Today we're talking about the 1% rule in real estate. Let's go right into it. This is it's really more like a guideline than a rule. I'll explain in a little bit here, but it helps you as a landlord quickly sift through dozens of potential properties to find potential hot deals. So, what are we going to learn today? What's the 1% rule? We're going to help you go right through properties fast to be able to throw aside the ones that aren't a good fit potentially and be able to hone in on the ones that could make you a lot of money. We're going to talk about the actual examples of the 1% rule, and we're going to talk about the pros and cons of whether this should be your only buying criteria. So, a little bit about me. I have been a real estate investor full time for the past 2 decades. And I'm also a real estate broker in 2 states and a serial entrepreneur. I've published several books on real estate, including this latest one, How to Become a Wealthy Real Estate Investor 101 Things You Need to Know Right Now. Check it out on Barnes and Noble or Amazon. I graduated from the Wharton School of Business. I was in the same class as Elon Musk. And I really am passionate about investing and sharing what I know. I don't want you to make the same colossal mistakes that I made. So let me tell you about what I know so you can make money and have less stress. So, the 1% rule. What is it? Well, this term has been around for a while, but it really became popularized after the Great Recession as there were a lot of properties selling really cheap and a lot of renters out there. So um, the investors at the time had a lot of properties to sift through, and they came up with this 1% rule as a guideline on which ones to focus on. It's, as I mentioned, more of a guideline. It's really a rule of thumb, not a hard and fast criterion for buying something. You just want to know if a property is worth taking a closer look. I mean, if you think about it, you could go on Zillow or Realtor.com, or maybe your realtor sends you 25 properties. Well, how do you know which ones to look at? You're not going to schedule showings at all 25. So you got to be able to figure out if there's one or two, or maybe three or four that are worth taking a closer look. And the 1% rule is broken down very simply is the rent to price ratio. In other words, you don't really consider a property unless you're confident the rent is at least 1% of the purchase price. So, what do I mean by that? All right, so let's say hypothetically that the potential rent of a vacant property, or at least the property that's not rented, is $2,000 a month. Or maybe it currently has a lease in place for 2000 a month. So let's say your realtor tells you, "Hey, there's a tenant in there now at 2000 a month." And let's say the asking price is $200,000. And for this example, the house is move-in ready. Doesn't need anything to fix it up. So, using the rent to price ratio, $2,000 divided by $200,000 equals 1%. So, if you're following the 1% rule, you'd say, "Hey, I am really interested in this property. Let's go see it. Let's run some numbers. Let's make an offer." Why? Because it's likely to produce positive cash flow on a monthly basis if you're financing. One thing I want to mention is if you're a cash buyer, the 1% rule is still an interesting guideline, but a cash buyer is going to have positive cash flow regardless. But the 1% rule is especially useful for somebody who's using leverage. That's financing, whether you're using a purchase money mortgage to buy the property up front, or if you're buying it in cash and then doing a cash out refinance later. That's known as the Burr method: buy, renovate, rent, refinance, and repeat. Check out my other videos on Burr. Uh, I'm, I'm happy to share more with you in those videos and also on my website, investandtransform.com. So, back to the example. How do you know if this property that you can buy for $200,000 and which is easily rented for $2,000 a month will produce cash flow? So let's assume that you borrowed 80%. That's $160,000. In other words, you're putting down 20%, which is $40,000 to buy this property. And let's say your mortgage interest rate is 7.5%. So your principal and interest is $1,119 a month. And as we said in the example, you're bringing in $2,000 a month in rent. So then we got to look at the operating expenses. So your homeowner's insurance, your property taxes, your repairs when things break, your maintenance, such as snow removal or cleaning the leaves off the roof or servicing the HVAC system, and then your vacancy has to be factored in. So let's say all of that is $600 a month. So if you're bringing in $2,000 a month in rent, there's $600 a month in operating expenses and $1,119 a month in principal and interest. That means that your free cash flow every month is $281. Now, some landlords say, well, I won't buy a property unless I can get cash flow of at least $200 a month. Others may say I need at least $300 a month per unit or $400 a month. But here in this example, by following the 1% rule, we see that this property is on track to produce $281 in free cash flow per month. That's positive cash flow. And that ain't bad. That's a deal I would seriously consider. So let's look at some other examples to see if you should pursue it. So let's say the rent on another property is $1,500 a month and they're asking $200,000. Well, the rent to price ratio is 1,500 divided by 200,000. That's 0.75%. Does not meet the 1% rule guideline. Okay. So let's say another example is that the rent is $2,000 a month and the asking price is $150,000 a month. Well, $2,000 divided by $150,000 is 1.33%. Yeah. If you're abiding by the 1% rule, you would jump on this deal. So there's some things to keep in mind. The 1% rule, as I mentioned, is really just a guideline. You're just using it to sift through uh, dozens of properties to maybe go see a handful. Your cash flow, remember, if if the outcome is positive cash flow, among other things, your cash flow is affected by the amount borrowed, your interest rate, the rent you're bringing in, and operating expenses. So think about it this way: what if you borrowed 100% instead of 80%? What if your interest rate were 10% instead of 7.5%? What if you didn't charge enough rent? You have a below market rent on your hands. What if you have high operating expenses? Things keep breaking. You've got, like, for example, galvanized plumbing that needs to be replaced with PEX or, PVC pipes or things like that. Uh, Keep in mind that two properties selling at the same price can have wildly different operating expenses and cash flow. I've owned lots of properties in Pennsylvania, where I'm from, and also lots of properties in Tennessee, where I live now. And in Pennsylvania, the property taxes tend to run 5 times as much as the property taxes in Tennessee. It doesn't mean that I didn't have cash flow in Pennsylvania, but that's a consideration. Also in Pennsylvania, the state personal income tax is 3.07%, whereas in Tennessee, there is no zero state personal income tax. So that's another factor because taxes are an expense to consider. Now, other factors, appreciation. You see, some investors will buy in a nicer neighborhood and maybe they'll even sacrifice cash flow, meaning that they will buy a property that produces a negative cash flow or perhaps is break even each month or maybe only makes $100 a month in free cash flow. These investors who are focused on appreciation are basically buying to get the property to increase in value dramatically in the coming years. And they may also be factoring in depreciation on their taxes because that's a wonderful deduction. A residential property can depreciate it over 27 and a half years, a commercial property typically over 39 years. So that's a phantom deduction that you can take. And then, of course, your exit strategy matters. Again, house flippers don't really care about the 1% rule. This is more for landlords. And there are some landlords who are doing things like buying properties and then doing 1031 tax deferred exchanges several years later to buy a bigger property. So they're going to just sell the property and then buy another one. And maybe the 1% rule is not as important deciding factor because they're using other tax savings and advantages to their, to build their wealth. Some other things. A property that appears to meet the 1% rule. Well, think about this. It may meet the 1% rule when you're initially evaluating it. Like we talked about an example where the seller is asking $200,000 and the rent is $2,000. And you're like, wow, let me get on this. But what if there are 10 offers on it because it's underpriced or very desirable, and so later it sells for $235,000? Well, the 1% rule then is, is not uh, there anymore. It was when you first looked at it, but with all the offers driving the price up, the property now is the rent to right price ratio is at 0.85%. Now, also, what if the property requires tons of renovation work that you did not anticipate up front? You buy it for 200 grand, you know it's going to rent for 2,000, but you find out you need to spend 50 grand to fix it up the right way. So, again, you didn't meet the 1% rule, even though it started out that way. Another thing to keep in mind is that if a property doesn't initially meet the 1% rule, there is the possibility for you to make an offer that is well below the asking price, and maybe the seller will accept it. Think about this: there's a property listed for 250 grand, been on the market for almost a year. You offer $200,000 and they take it. So the 1% rule is met, even though some investors would have bypassed this deal up front because they would have said, "Hey, they're asking 250 and it's only renting for 2,000 a month. I don't want it." Well, you changed the situation by making a low offer that the seller accepted. Also, keep in mind that you don't have to meet the 1% rule all the time to make money in terms of cash flow and appreciation and depreciation. Many neighborhoods that are growing or desirable or working class, they may have properties that are selling more along the 0.8% rent to price ratio, and that could still produce lots of positive cash flow. If you're playing the long game, which is to buy properties and maybe never even sell them, buying at a criteria less than 1% rent to price ratio may be in your favor. Also, there are some, let's say, rougher neighborhoods. Maybe you don't feel safe at night in these neighborhoods. There's high crime or high tenant turnover, or they're just declining because the population is going down. Well, you might have to apply a different rent to price ratio, like 2%. That's known as the 2% rule. Here we are, 1% rule now, a 2% rule. For example, let's say there's a house that you could buy for $70,000 and you can collect 1,400 a month in rent. Well, that is a 2% rent to price ratio. See, some landlords in the neighborhoods that are in decline or have lower sale prices but high tenant turnover or require a lot of maintenance, the properties are fairly run down. Basically, the investors are saying, I want a higher amount of rent per month to offset the risk and the expenses that I'm taking on. So let's look at an exact actual example here. This is a house that my wife Amir and I purchased a couple years ago. It was initially listed for $160,000 and we offered $158,000. Now, with this particular house, we don't do this often. We usually buy in cash, but with this one, we got a lucrative 15% down, non-owner occupied conventional loan at 4.375% interest. So we jumped all over it, made an offer with that loan, and we said we would waive all inspections. And we also actually waived the appraisal contingency. So we said we don't care what it appraises for. If it under appraises, we'll make up the difference. Well, there were three total offers on it within a week, and the other two were over the asking price. Yet the seller accepted our offer. Okay, so we did spend $9,355 on upgrades in the first week, and we then rented it for $2,000 a month. 2,000. So look at the numbers here, very simple. I'm not including closing costs in here just to keep it simple, but we paid $158,000 plus $9,355 in upgrades. So we were into the deal for $167,355. The rent to price ratio is $2,000 divided by 167,355. That's a 1.2% rent to price ratio. So let's do a little sifting and hunting for a possible deal. Um, we'll start with Zillow. A lot of you use Zillow. Let's say you go to here at the Zillow and you go to buy homes for sale. I live in Knoxville, so I have it set up here for sale. 100,000 to $300,000 price range. Home type. I eliminated manufactured homes. I personally don't like to own mobile or manufactured homes. I have in the past. Just prefer to detach single family homes right now, or maybe townhouses, condos, things like that. So let's look here at potential deals. All right. So, well, let's go to this first one. Listed for $220,000, 3 beds, 1 bath, 912 square feet, 2233 Sylvania Avenue. So, one thing that I use as a tool, it's really helpful. It's worth the annual subscription. We currently pay $99 a year for this. It's rentometer.com, spelled out rentometer.com. So, let's go there. Let's enter in the address. We pay for the pro account. Sylvania Avenue Southeast. 3 bedrooms using a smart radius, which is about 1.5 miles. I'm going to analyze it. So we're analyzing this property, and here we go. Very quickly, it shoots up. I look at the average rent for the area, the median, very close to the average. Median means that 50% of the rental comps they evaluated in rentometer.com were below 1875, and 50% were above 1875 a month. Now, one thing that my wife Amir and I do is we focus a lot on the 75th percentile. That means that's the top 1/4 of properties. That is an indicator of the higher end of the market rents. Now, my wife and I, we do renovate our properties to be nicer than the standard that we tend to find. Like we observe what some other rentals in the area are like, and we try to have our rentals be just little more modern or a little better, it's well maintained. And so you're looking at $1,995, maybe $2,000 a month. Let's go back to that property we were considering. Well, it's listed for $220,000, and the top end of the rent we think we can get is $2,000 a month. So this property does not quite meet the 1% rule criteria. But what we'll do is we just go here and we just pull up photos just to take a quick look. Is it a fixer upper? If it's a fixer upper, that means we got to spend even more money. And then, well, we'll see what happens. So let's look at the photos. Uh, Only 4 photos. Nah, it's not many. So it's ready for your renovations. It says, look, it's right here. This house is ready for your renovations. So it's not really going to meet the 1% rule criteria because it's already listed at 220,000, and maybe it can collect 2,000 at best a month in rent, and it needs work. And the fact that it only has 4 photos makes me think that there's a lot of work. All of a sudden I'm like, next. So that is just us really quickly sifting through this one property to find a potential deal. You can do this in your area by using Zillow or Realtor.com or whatever website you want. Um, we are realtors, so we are able to get access to the MLS, which is very helpful. Most of you are not realtors. That's okay. You can ask your realtor to send you properties on an automated email or something like that. Like our Facebook page, Invest and Transform, tons of free tips there. Go to our website, investandtransform.com. We've put, for example, a free ebook on creative financing techniques for house flippers and wholesalers. We have lots of blogs there, like a blog on the 1% rule, the 2% rule, among many others. So check that out. Lots of great tips for you. We want you to make lots of money in real estate without the stress, without the hassle, without making colossal mistakes. Learn from my mistakes. I really want to help you. And check out my latest book, How to Become a Wealthy Real Estate Investor 101 Things You Need to Know Right Now. It's available on Barnes& and Noble and